Today we will be covering our recent blog on our website, which is Invest for Wealth, and the motto and the belief of this website and this portal is to be aware and be calm. So we will be covering our recent blog under Forex and bonds update, and which will be USD to INR price and forecast. Here USD of course represents US dollar and INR is Indian National Rupee. So USD to INR price and forecast is expected to go up in times to come. And this is very important for you to hedge accordingly, irrespective of the nature of your profession. The current USD to INR price is 75.13, and our forecast by 2030 is of 100 plus. That means that we expect Indian currency to depreciate by somewhere close to 30 to 40% in this decade. And there are certain reasons for the same, which we will be covering. So, there are innumerable factors that influences the conversion rate of a currency. So, if we talk about INR to USD, there are several factors which are governing it. So, let's try to look at those major factors one by one. So, the first one is macroeconomic factors. So, higher rank in terms of strength and efficacy of a country's institution and policymakers leads to lower yields. Effectiveness of government and its policy, its accountability and strength of the legal system are qualitative measures of the degree to which a respective sovereign borrower can be expected to implement policies and measures that are consistent with sound management of the economy in general and of its debt obligations. Health of a currency is directly proportional to the macroeconomic factors of a country. In the case of India, the reforms which started in 1991 were supplemented by key reforms like GST, it came in 2016, then demonetization again 2016, NCLT, RERA, Jandhan, etc., which will be long-term beneficial for India's growth, and it will actually protect the downside of Indian rupee in times to come. The second important factor is inflation. India had significantly higher inflation in the last decade compared to US. It was hovering around 4 to 7%, wherein it was around 1 to 2% in US. Even now and in times to come, it is expected that inflation differential in between India and US will be around 5%. USD to INR price and forecast is expected to go up by at least the differential amount, which will be what we think will be around 4 to 5% on a year-on-year basis, at least through 2030. The third factor which affects the equation of USD and INR is interest rates. So when interest rates are kept at zero by US Fed, RBI in India has cut down the repo rate by 25 basis points to 5.15% from 5.75% in August 21. In the same line, the reverse repo rate was also reduced to 4.9% from 5.5%. This huge difference in interest rates speaks for two economies and hints at depreciating rupee in long term. Our higher interest rates as compared to Western world puts pressure on our currency. The fourth factor is public debt. As of March 2021, India's external debt was placed at USD 570 billion, recording an increase of US dollar 11.5 billion over its level at end March 2020. The external debt to GDP ratio also increased to 21.1% at end of March 2021 from 20.6% at end of March 2020. Valuation loss due to the depreciation of the US dollar against Indian rupee and major currencies such as euro and pound sterling was placed at US dollar 6.8 billion. Excluding the valuation effect, the increase in external debt would have been US dollar 4.7 billion instead of US dollar 11.5 billion at end of March 2021 over end of March 2020. With the plans of government for this decade, public debt is expected to rise and will exert pressure on INR valuations versus US dollar. The fifth factor is demand and supply. Indian money is in demand not only from the domestic market for any transaction, but also from foreign money that needs to enter the country, exchanging dollars or other currencies into rupees. If there is remittance, it is also in demand. Remittance means that there is earning outside India flowing back through people working there, or foreign operations of Indian companies or exports. On the other hand, supply happens from RBI printing the money, and when currency is leaving the country and being exchanged for dollars. It is also supplied when we import things, as the price has to be paid in US dollar. Over a long period of time, this equation will lead to net flow of dollars outside India at least till 2030 and will lead to INR depreciation. One of the major factor here is the import of crude, as we all know. Otherwise, I would like to state that India imports 80 to 85% of its crude oil requirement from Middle East and from other countries. And if the price of crude goes up, it will put a huge pressure on our trade deficit, and this is quite depreciating for Indian rupee. And we expect that from our current capacity by 2030-35, and this will also lead to a pressure on INR. The sixth factor is economic growth. India is expected to grow at 10% this financial year, 2021-22. With better economic growth, there are investment avenues generated in the country which affects foreign capital. Also, higher GDP growth lead to lower yields. First, government tax revenue increases leading to lower deficit and debt levels and gives better financial resources to service debt. Second, as we attract more foreign capital investment, which increases our US dollar reserves, it allows us to service our debt easily. Seventh factor is current and fiscal account deficit. In the case of India, both of these are negative. Currently, fiscal deficit is around 6%. India's current account balance recorded a deficit of $8.1 billion, which is 1% of GDP, in the quarter ended March of 2021, on the back of a higher trade deficit and lower net invisible receipts. Higher fiscal and current account deficit mean higher yields and pressure on currency. Eighth factor is central bank intervention, depending upon whether it's a free market currency or fixed. India's currency exchange is free and market driven. However, from time to time, there is intervention by central bank to absorb shocks, but they don't interfere with the free market dynamics and policies. Our currency has depreciated from 45 in 2011 to 75 in 2021, close to 67% in 10 years, and the trend is expected to continue. So, with the above mentioned factors in consideration, and most importantly, with no current plan by Indian government to position INR in an international trade as a big reserve currency for other countries, which could have protected its downside in case of depreciation because of the above mentioned factors, our prediction for USD to INR is 100 plus by 2030. This is our update on USD to INR current price and its price prediction by the end of this decade. For more updates on Forex and bonds, you can click this link below, and it will take it to more such updates, which will be beneficial to you for your investments and for your financial health. Thank you so much for your time. Take care. Bye-bye.